evening, HT viewers. Welcome to Equity News on Equity Access, your area perspective of stock market developments and of developments in the Zimbabwean economy. Thank you for joining us as we broadcast live from our Hampton studios in Harare. Ibn Mabunda. Let's get started. The Zimbabwean Economic Society held a mid-term budget review breakfast meeting in the capital, which was attended by captains of industry as well as leaders in government. Speaking at the event, the permanent secretary in the Ministry of Finance, Dr. George Matanga, said government had embarked on a power debt restructuring exercise and also engaged investors to address power concerns in the country. He also said that due to the restructuring, the power situation should improve with effect from Tuesday, the 6th of August. Our Equity Access team was on the ground. Let's have a look.
I think the amendment that we put into place now on electricity should hopefully guarantee us increased supply from tomorrow or Wednesday. We have been engaging with the suppliers of electricity, whom I would not want to mention because it's not my role to mention them, but we have actually agreed on some of the repayment terms of the debt. I think the first installment was made last week. We are going to be making weekly installments for the legacy debt, and we have also agreed that we then might pay on a current basis for the supplies that we are now going to be using. And working with the mining sector, we have been able to ring-fence adequate resources to pay for at least 400 megawatts of electricity per month, depending on where we are going to be buying it and who is going to be supplying it, because there are different prices. But we certainly expect that the power situation, having concluded with one of the suppliers, should improve starting tomorrow or from Wednesday. But we are then engaging the other supplier as well to try and see whether we can put into place a similar structure. But what we will now need to do is to find the resources which will ring-fence to be able to pay the consumption that we might obtain from that supplier. The reality of electricity really is we were hit hard in Kariba.
Also speaking at the particular event, the Minister of Finance, Professor Mthuli Ncube, did shed light on government's revision of its GDP projections in the Transitional Stabilization Program as well as in the issuance of the 2019 budget. The Minister of Finance had projected a growth in terms of our GDP to 3.1%. But now he says because of what is played out in the economy as well as other natural events that have affected the productivity in the economy, we could be headed toward a GDP decline. Hence, he did shed light on how the country is now expecting a GDP decline of 2%. This is in line with IMF and World Bank projections, which have projected GDP declines of 3.1% and 5.2% respectively. Again, our Equity Access team gives us the footage. Let's have a look.
The state of the economy in Parliament, we're going to say that, you know what, GDP growth is going to be negative. This is about 2 months ago. So the TSP GDP growth target is no longer valid. These are the facts. These are the facts. It can't be valid, not with this kind of power. It cannot be valid with power cuts. So it's negative growth. So now we're looking at minus 3% as opposed to 9% or whatever. There's been a recalibration complete because of that. Then and by the way, this drought, let me say this, when we were planning around the TSP, frankly, we did not have full information on the seriousness of the drought in September. Actually, we didn't even think it was going to occur. To me, things started happening when we started watching the agricultural sector. Rainfall, pattern, slate, sparse, intermittent, what's going on here? And digging deeper and listening to the meteorologists around the world, we knew where we were in trouble. So this became a shock to the system, and we just had to deal with that shock and recalibrate.
Now, also at the event, entrepreneur as well as economist Dr. Naju Janakira called upon government to create an investor-friendly environment so as to attract foreign direct investment into the country. Again, let's have a look.
Fancy footwork for us to actually recover and begin to see the prosperity that you are addressing. I think the focus was really that we don't keep looking back. And I think we were fortunate as the Zimbabwe Economic Society to have the governor in attendance just 2 weeks ago. And it was fortunate that he gave us the stats in terms of what's happened on the balance of payments front up until June. And from a balance of payments front, were it not the borrowings that we were able to pick up of about the loans, loan financing that we got, about 500 odd million, only then were we able to show some recovery. Because production was down, as I indicate, exports were down, and so we have some real issues and some fancy footwork to actually undertake. Going forward, and this is where, maybe just up until June, wherein we actually have the figures, investment inflows in terms of some of the transactions that we've been wanting remain very, very low. As you know, Honorable Minister, our regional counterparts are attracting anything to the order of $6 billion per annum in terms of foreign direct investment inflows. We ourselves, on an annual basis, at best, have done just about $480 million in terms of foreign direct investment. If you care to look at the stats, again, in the first half of the year, the actual inflows will not yield what we are looking for in terms of actual inflows. Whether it was caution as a result of speculative activity that took place and saw our currency virtually collapse up until your intervention to avert what would have been a disaster. I think people sat on the fence. And the signals that they are looking for are signals that will show some element of stability and some capacity to be able to remit their dividends and forex requirements and payments as and when they need them. So I think your timing in terms of the offshore banks or companies becomes imperative.
Also from the same event, the Chief Executive Officer of the United Refinery Limited, who is also the chairperson of the Presidential Advisory Committee, who is Mr. Busisa Moyo, said that government had done well to bring about consolidation on the fiscal front as well as on the current account balance. He, however, said that there was a moral deficit that needed to be addressed in the country: corruption. Let's have a look as he speaks on the sidelines of that particular event.
A good job to balance the twin deficit, but there were three. I had three deficits. One was the trade, the other one was the fiscal, but we also have a moral deficit problem, which manifests itself in the form of corruption. I mean, brazen, overt corruption. And all these great plans in the TSP will not see the light of day if we do not tackle this final beast.
In other news, Padenga Holdings diversifies into mining. Following a series of cautionary statements, Padenga issued a statement highlighting the acquisition of a majority stake in Dalaglio Investments. The deal is subject to shareholders' approval at a soon-coming extraordinary general meeting. Dalaglio Investments is a mining company with investments in Pickstone, Peerless Mine and Eureka Gold Mine. This, of course, is a follow-up to what Padenga has been indicating over the past several months, that they intend to invest in an export-oriented business. Padenga is invested in an export business, specializing in several products, among them the exportation of crocodile meat as well as crocodile skins. In another story, Getbucks raises 35 million Zimbabwean dollars in subscriptions through its rights offer made on the 21st of June 2019. This is 50% of the total rights offer made. Getbucks is a financial services provider and is looking to launch as a fully fledged commercial bank. This concludes our evening news bulletin. Up next is a review of the news in News Review. Please stay tuned.
Climbing to the top takes more than just hard work and smart choices. It's the passion that drives you from within, the endurance to keep going through difficult times, and having a very clear vision of how to succeed. That's what we strive for at CBZ. We're a diversified and innovative listed financial services group in Zimbabwe with a complete range of activities including banking, short and long-term insurance, asset management, and property investments. CBZ has been a pinnacle for stability in the economic landscape of Zimbabwe, stemming from our deep-rooted values, our excellent customer service delivery, and our corporate vision to strive for excellence as a global competitor. Our continuous investment in research and development will cement our promise to provide customer convenience utilizing state-of-the-art technology. Relationships are at the core of what we do. We understand, however, that strong, long-lasting partnerships are not built overnight. With over 3 decades of wealth management, we have come to understand our clients and their specific investment requirements. Our unique mix of skills ensures that investment opportunities are examined from all perspectives. The balancing rocks of Zimbabwe have weathered the elements for thousands of years and stood the test of time, like majestic reminders of the fine balance of nature. They challenge our perception of what is possible and what endures. Just as CBZ has weathered the economic storms and remained steadfast throughout the turbulence of unsettled economies. Achieving the impossible through resilience and stability, we balance the elements of hard work, dedication, and experience, making us your ideal partner for success.
News Review, and with me on set is our very own economist, Tinashe Kaduo. Tinashe, good evening and welcome to the show.
Thank you, Eben. Good evening. How are you today?
Won't complain. You don't get better yourself?
I'm very well. How was your weekend?
Splendid as always. Now let's get the ball rolling. An interesting event there hosted by the Zimbabwean Economic Society. Several key issues we have seen. Leaders from government, leaders from the private sector convening to discuss teensy-weensy details of the progression of the Zimbabwean economy. One of the key issues that we highlighted by private sector are issues to do with the command agriculture. The government has allocated more than $2 billion toward a good 210,000 hectares of maize, 30,000 hectares of soybeans. What is your comment where that is concerned, especially where there is that call for efficiency where that system is concerned?
First of all, if you look at the command agriculture per se, the command agriculture, when it started in 2016, it started as a special maize production where the focus was to reform even the production of maize, which is our staple crop. If you look at the past couple of years, we had seen, most of the farmers are shunning maize, maybe moving away from maize to other lucrative crops such as tobacco and other higher earning crops in terms of value. So we have seen from 2009 to period, let's say to 2016, we had seen production in terms of maize production coming down from the previous productions. Then as a nation, we were actually failing to meet our annual requirements of around 1.5 million tons to 2 million tons of maize if you consider both human consumption as well as animal requirements. So the government came in with that policy to try to revamp the sector. So it actually, the command agriculture then expanded from maize alone to other sectors. But this coming season, we are coming from a base where production fell significantly due to the adverse season. The 2018-19 farming season wasn't that good for farmers. So I think that budget of around 2 billion, which was announced by the finance minister in the supplementary budget, I think it might help to cushion farmers. But if you try to break it down, 2 billion Zimbabwean dollars right now, if you convert it into US dollars, maybe by an average interbank rate of 10, it's around 213 million US dollars. Then if you look at the inputs for, let's say, maize, for instance, I think 80% of the requirements of maize, aside from the seed itself, I think it's imported. You look at the capacity of those, fertilizer manufacturers, they source almost of their raw materials or all their inputs from South Africa, and even as far as Brazil and Mexico. So I think maybe in terms of the budget, to me, yes, it's justifiable that the government has set aside certain resources to revamp that. But what's needed there, to me, which is lacking in the Command Agriculture program, is the monitoring and evaluation part of it. Every policy needs monitoring and evaluation. So to me, farmers who are contracted by the government should ensure that they have delivered that produce to GMB, and that the government should insist on recovering the command loans, such that the policy becomes more efficient and will meet the target that we want as a nation. Then also, the other aspect that is missing in the command agriculture is the insurance part. We are looking at a country that relies much on rain-fed agriculture. If you look at any investment, even without insurance, it's actually an added risk factor. You can't do business, you can't invest, and you can't trust yourself to reap full benefits when you haven't insured yourself. So we are seeing farmers in a certain season, they will be devastated and ravaged by certain things that they couldn't control. You look at the past farming season, we had that prolonged dry spell from December to February. Then from February, we had some bit of rains. But by then, some of the maize crop had already gone under the permanent wilt stage. Then from there, there was that cyclone Idai, which actually destroyed some of the maize crop. So all those dynamics, I think there is a strong call there where the private sector should come in and maybe knock at the doors of the Minister of Agriculture, at Honorable Shiri's office, that no, Honorable Shiri, in this Command Agriculture Initiative, it's a noble idea, but include one or two things. Those are the missing links to make that program, viable. One of it is insurance. I'm passionate about that. We have good insurance. We have companies there who are able, to cover that cost, and even to share that risk with many players there. They can even, find some reinsurers out there outside our borders who will be able, to share that risk, such that the whole risk is mitigated and our farmers are viable, and they will be able, to come back very strong and with a very strong, financial footing in the next season. But without this, I'm seeing a situation where each and every year the farmers will be relying on the command initiatives as well as other government programs in terms of financial support.
Interesting. Now, also speaking at the event, Dr. Naju Janakira, they calling upon government to set up investor-friendly environment so that we can attract more foreign direct investment. He did, of course, refer to what we've seen play out as what he called a VUCA economy, just to explain the melodrama that we've seen play out on the markets, and as well as from a policy perspective. Your take where that is concerned?
Even if you look at what's happening in this economy from November 2017, where we have this second republic, there's this too much focus on having or on trying to attract foreigners to invest in the country. But to me, what you should do first is business begins at home. Just like we learned at school that charity begins at home, even is that's also that has to be done. If the government, institute certain policies that are friendly, that supports even local businesses, then we have those growth stories. That there was a company that's operating in Zimbabwe, a local company which has done well and is successful. That story will sell the Zimbabwean story out there. You can't attract a foreigner when your own businesses are not flourishing. That's not the right policy approach to take. So to me, to center our policy towards attracting foreigners, I don't think that should be our core policy thrust.
Just to come in there, Najo said, look, we as Zimbabweans are bankrupt of confidence. So what we would need to do is restore confidence in local businesses, which ultimately would feed into the international investor confidence as well.
That I agree. That I agree. Rather than maybe just to focus your policies on attracting foreign investment. If we institute certain policies that will make our local businesses, our local entrepreneurs successful, then we might see those local entrepreneurs selling that that growth story elsewhere, and we'll be seeing capital coming in.
I realize. Now, interesting development. Permanent Secretary Dr. George Kwamatanga says the government has embarked on some debt restructuring exercise for ZESA, as well as has also brought in some investors where that particular field is concerned. And then he says we can expect a bit of a shift in terms of our load shedding between tomorrow and Wednesday. How significant is this particular development? Do you think we're actually going to see some drops come off the pump?
I think it's needed. It's really needed. You look at when we don't have power, each and every sector, it suffers. We are actually at the peak of the wheat farming season. Wheat, it's a winter crop, and I remember talking to the president of the Farmers Union, saying that some of the farmers are actually counting losses already because of these power cuts. So I think if the government tries maybe to do something to make the power situation better in the shortest period of time, I think it will help to resuscitate some of that wheat that has gone, that has been affected by these power challenges. But you look at how parastatals in Zimbabwe are being run. That's where the problem is. Most of our parastatals, they are in a loss position even, and they are persistently and consistently draining the fiscus, burdening the taxpayers as well as the general public. So one of these measures I think the government should do is to restructure ZESA and all its affiliated companies, maybe to regroup it into a one entity and make sure that it's being run efficiently. Having so many companies supporting one initiative which is just providing electricity. We have your ZESA, you have ZPC, you have ZETDC. I think we should go back where we have just a holding company in the name of ZESA and does all those operations efficiently. What I would have wanted is the government maybe to take a very strong approach where they say the board or even the senior management of, let's say, that key institute as ZESA should report maybe to Parliament on a monthly basis or a weekly basis, updating the Parliament on the developments they are undertaking in terms of alleviating this crisis. This is actually a national crisis. There is no business that can operate and there is no investor that can be attracted in a country which experiences of blackouts of up to 14 hours a day. If you want to invest in Zimbabwe and you have seen a certain business opportunity, then you hear that there is no power. How can you invest in a country like that? That's one of those issues that need an immediate attention.
Interesting. Then, of course, the Minister of Finance did make mention of the fact that, let me say, reiterated the fact that government has had to review the GDP projections, now projecting a GDP decline of 2% from a positive prior projection of 3.1%. How important is that revision?
I think they've just taken those projections which were inside under the staff monitored program. But you look at what's happening in the economy. Mining sector is now, when you compare it to same period last year, I think we are down by at least 20%. You look at also at the agriculture sector, I think it will be down by at least 15%. You look at the tourism industry, last year I think that election mode actually attracted a bit of conferencing visiting by those international observers and other international organizations. Then this year the traffic is not that much high, so the tourism industry will also suffer a knock. You look at the financial service sector, it's not doing well. The manufacturing sector, I think the industry minister he had highlighted that the manufacturing sector might grow by at least by 1%, down from 3% that he had earlier on projected. But I think in the supplementary budget, they are actually projecting a recession in the manufacturing sector. So the manufacturing sector actually is driven by your agriculture sector. When your agriculture sector underperforms, it means that the manufacturing sector also underperforms. Then the energy, it's key to all sectors. When you have got blackouts of 14 hours, like I was saying earlier, it means that the whole economy won't function. So technically, we are in a recession, and I don't just call it a recession. We are in a period of high inflation as well as deep, economic inactivity. So that combination is of stagflation, which I'm sorry, it's a very difficult economic situation to come out of. So the finance minister, to revise those projections downwards, I think is becoming, trying to become a bit real. But the negative 2%, I think, is more on the optimism side. Because some of us, we are actually projecting a deeper recession of at least, a negative 10%. So we might, grow by negative 10%, negative 12% against, that IMF target, IMF projection of negative 5.2%.
Interesting projection. Now, talking about the volatility in the local market, Padenga hinted at their previous analyst briefing that they were investing in an export-oriented business, and now the details have been unraveled, and details are actually that they are acquiring a majority stake in a company called Delagla Investments, which has got investments in Pixton PLS mine, Eureka Gold mine, and the like. So how important is that move? How important is that initiative for Padenga? Of course, this is yet to be approved by the shareholders at a soon coming annual general meeting, to be precise on the 20th of August. How important is this move?
You look at Padenga. Padenga is actually entirely a foreign currency business. If you look at their crocodile business and what they are doing in that resort town of Kariba there, I think they are entirely a foreign currency generating business. Then also diversifying into gold production, or having a stake in a gold production entity. I think they are actually cementing their foreign currency business, which I think it's positive for them. You are seeing that it's more of a company that had any exposure even in just one area, your crocodiles and that related businesses. Then coming into gold, I think it's something that's really important to them, which will enhance their sustainability and diversification of its income in light of all these macroeconomic and even global turbulences.
Interesting. Well, thank you, Tinashe, for the perspectives. Thank you, VS, for staying with us. Up next is a look at the stock markets in Markets Daily. Don't go anywhere.
Good evening, ladies and gentlemen. Welcome to Markets Daily on Equity Access. My name is Anis Chimpumu, and let's just get into the markets now. The month of July did close off with a 3-month low in terms of turnover for trades on the stock market, with trades just coming in just around about $191 million. A lot of investors had been trying to find direction in terms of where the market should be going, or where they would actually put their money, especially considering that there were a lot of monetary policy pronouncements and different foreign exchange directives that did come through within that month. Also, so some confusion did cause for a lack of trading on the stock market, as we also did experience a very suppressed number of trades that did go through in the month of July comparative to prior months. Now, as of today, the market did come off again today. It did mimic for both the all-share index and the industrials index, coming off 0.25%. For the industrials index is still at 614.43 points, while the all-share index is at 184.16 points. Now, year-to-date gains have been continually been slimmed down to 25.96 for year-to-date for the all-share index, while 26.14% for the industrials index. Now, top 20 index is now down 18.74% on a year-to-date perspective, 0.34% down today, selling at 172.18 points. Consequent to that is a big negative loss, actually, by the local bosses, largest counter in terms of market cap, after having it dropped about 1.27% on its share value, selling at 153.77 cents. Now, Delta and Cassava did also follow suit within that regard. Insco, also one of the laggards within the top 10 counters. Old Mutual is still making some huge movements northward, coming up 1.41%. Now, Padenga was stable today. They did issue a very interesting statement. Now, for so long, we have been waiting to hear what this new business that they look forward to getting into, which is obviously export oriented, and when they did hold their AGM back in May, they did mention that there were a couple of issues that they still had to iron out and find out whether to actually still get into the deal, but then it was pretty much almost done. And as of today, they did issue a cautionary statement mentioning that they are getting into a diversification of mining. Now, within that mining business, which is pretty much under Deleglio Mining Corporation, where one of major investors would be Vast Resources, which owns about 23% indirectly within that business. Now, what's interesting for me for within Padenga's perspective is that these guys are bringing in $20 million worth of equipment for this mining for the mining operations, and I think it will be a very good perspective for them, even though we are facing a lot of power challenges currently. Going forward into the future, they are expecting it to reap some pretty good fruits. One of the mines which are popularly known and is situated in Mass Central is Eureka Mine. It's predominantly a gold mine. It has a life of mine of about 17 years and has the potential to do about 1.5 to 2 tons a year, which is pretty much huge. Now, when Vast Resources injected about 60 million back in 2018, they also were expecting about 140 kgs of gold and 1,000 kgs in terms of ore per month. So it should still translate to that 1.5 to 2 tons a year within that regard. And with gold prices firming currently, it would be very much of a good business for them. I mean, they're going to be enjoying a good number of earnings from that, especially considering that they're now about 50.1% owners of that business. Now 2.79% down for the all share index, selling at 184.16 as of last Tuesday. Mining's index is stable at 0% as it has now come off, as it has now pretty much stayed stable for the last 3 sessions. The top 10 index down 3.77%. Now, as onto our rises and fallers, Old Mutual was leading the pack, while banking stock did come up 1.03% for it to settle at 26.5 cents. Citco International Limited selling at 212.24 cents after having added 0.06%. Axia did settle at 48.01 cents after having added 0.04% for it to cap the set of rises. Now for our laggards, Edgar's did come off 5.44% to settle at 15.13 cents. Simbisa settled at 92.04 cents after having led up 3.12%. I would suggest maybe there was a little bit of a shocker for some investors today, especially that there was an article within the business headlines where they did mention that they have lost out about 78,000 due to the electricity power cuts, which has pretty much caused them to have a much more rational schedule in terms of their operating hours, and also has pushed up their costs in terms of them trying to keep their business afloat. So it will eat into their revenues within the current if this problem keeps on persisting, continuing forward. Now, as we just close off the show, our forex market was pretty much the same story as of last Friday and every other day in the past couple of weeks, except for the para market having strengthened a little bit, coming in at 10.5. Well, much of that strengthening has come from a perspective where weekend trades are pretty much very low, and this would actually normally drive down the rates to as low as about 10.2, 10.1 during the weekend, and as of today it did come back up, but it only managed to settle at 10.5, which is pretty much lower than last week Friday's rate of about 10.6. Interbank rate has weakened by about 1.2% today, selling at 9.4, while the while the Old Mutual implied rate is at 14.4. Much to do with the continued free fall by the Old Mutual counter there on the JSE. Now for the interbank market, it seems as if there's still a little bit of lack of supply, but then rumor has it on the street that some banks have been actually willing to sell their foreign currency at the current moment, but then I suppose for most businesses it'll be a little bit difficult for them to actually approach banks for them to buy out some foreign currency, so as to avoid a little bit of more scrutiny in terms of government really looking into what they're doing and avoiding trying to get themselves in a much more difficult situation than they are right now. Now, for a much more detailed report in terms of how the forex market has been performing, we also believe that it may continue to weaken at this rate, and prices will continue to go ahead within that regard, especially considering that a lot of individuals and businesses are still thinking in the US dollar terms, and pretty much to our surprise, the government still has that US dollar mentality, because you would not find such kind of mentality from the government, especially if they still peg electricity bills or other rates at what the US dollar equivalent could be. Now, for them to actually still make sense and have us have a much more reliable source of power that should be coming in, they shouldn't be really worried as to how much we are actually charging versus what they should actually be charging at the current moment. Now, do not forget to like, follow, and subscribe our YouTube and Facebook accounts, even including Twitter account at Equity Access, and do visit our website www.equityaccess.net. Good evening.